All right. Welcome to another episode of Tuesdays with Audi, and I am your host, Audi. I know from the day I started speaking about the stock market, many of you have been wondering, when is Audi going to tell us what to do in terms of investing in the stock market? Spoiler alert! I can't tell you what to do with your money because you guys are responsible adults. I don't know what your financial situation is. As well, I don't know what your temperament is when it comes to dealing with loss or your anxiety level as it pertains to your daily life. In addition to that, you shouldn't let a guy in a red shirt on a YouTube channel tell you what to do with your money. We all know that investment involves risk. And as I've said on this channel before, some of us wouldn't be here if it wasn't for a little risk. So go ahead, hit the like button. For those stopping by, welcome to TWA Nation. For those who are returning, thank you. TWA Nation, let me know, where are you currently in terms of your investment journey? Drop it in the comment down below. Have you started or are you still thinking about it? I would like to know where are we in terms of going on this journey as I go ahead and share this portfolio that I'm going to be creating for this episode today. So without further ado, let's get into today's topic, which is where I would invest if I was starting all over today. So we will be looking at starting with the adult dollar. And for some of us that don't know, here is our little friend Benjamin. He's still well and alive. I know some of us haven't seen him in a while, but he looks good. And his face is pretty much screwed. But anyways, here he is. Whoops, he's back together, guys. Nothing happened to him. He's still here. So let's put him away. Before we get into the video, disclaimer, the companies that I'm gonna be listing are companies that I've already invested in. In addition to that, most of this is done on the Robinhood platform because this allows me to purchase fractional shares because some of these companies are going to be worth over $100 in terms of their share price. So therefore, we cannot purchase the entire share with $100, especially distributed across multiple companies. All of the prices that will be reflected on this are as of June 25th when the market closed at 4 p.m. on Friday. And of course, this is not financial advice, so please do not take this as financial advice coming from me. Once again, this is Guy on YouTube in a red shirt, and I am not telling you what to do with your money, and these as well are examples of what I would potentially do if I was starting over again. So now that the elephant has been acknowledged, let's get into these 5 stocks that I would be listing that I would buy with my $100 if I was starting all over in the stock market. So the key thing I'm looking for in these companies are their book value to tell me how much the stock is currently worth based on their financials. And if the book value is more than the current price of the stock, I would consider buying it. The next thing I'm going to be looking for is a P ratio, which is a price to earning ratio of under 20, which can tell me is that if the company is earning more than its current share price, that means that the P ratio should be less. And the fact is that it's telling me what people in the market are willing to pay for this company as a multiple of what the earnings are. If I can find anything that's lower than 10, then that potentially may mean to me that people are undervaluing the stock as it relates to its earnings. And the last thing I'm looking for is dividend yield under 10%, which can tell me how long it will take my money to double in this particular company if I use the rule of 72, which tells me that if I take the number 72 and divide it by the rate of return of a particular company, it will tell me how long it will take for my money to double. For example, let's just say you find a company that has a dividend yield of 6%, then 72 divided by 6 is 12, so in 12 years, the dividend itself will pay you in terms of your initial investment that you have put into this company. While the dividends themselves may not necessarily last because these are paid under the discretion of these companies, and I'm not going to be chasing yield because yield itself, if it's higher, even though the company is paying more of its earnings in dividend, it also may signal that the company is very risky in terms of it paying all of this money as it's earning, and it may not have enough money for it to do other stuff, and we may potentially halt or stop paying dividends in the future. So keeping that in mind, even though I'm looking for under 10%, my best is to keep these companies I'm going to be listing under an 8% dividend yield. So without further ado, let us dive into these 5 stocks. And keep in mind, this can only be done with fractional share purchase, which is Robinhood that I'm using. And if you want to get a free stock, the link to this will be dropped in the description, and you can get a free stock and sign it up so that you can use Robinhood in order for you to actually go ahead and purchase whatever it is that you want to for any given company. So the very first 2 stocks on this list, they are both ETFs. And if you don't know about an ETF, episode 34 on this channel, I discuss what ETFs are and tell you why is it I find them attractive and what they can potentially do in terms of mitigating depression, as well as loss, as well as handling your anxiety as it pertains to investing in an ETF. The very first two companies on this list is like if you go to a pool and you have on a life jacket, but you are scared to go in, you can sit on the side of the pool and dip your toes in and get to feel the water, but there is still some risk that you may fall in. But nonetheless, you are protected and you are safe and you are on the side of the pool, so there is not much that may go wrong in terms of what it is that you are doing. But keep in mind, there's always risk with investment. The very first one in this list is the one I mentioned in episode 34 as well, which is the Vanguard S&P 500 Index ETF, ticker symbol VOO. Now for the reasons, you can also see them in that video as well. The next one on the list is the Vanguard Total Bond Market ETF, ticker symbol BND. Once again, same reason. The only difference is that now I'm looking at bonds, where bonds tend to actually behave opposite to what stocks are doing. So if stocks are doing well, bonds are likely going to take a hit. It may not be that bad, but then when stocks are not doing well, bond tends to do well. So therefore, I can balance the actual production of these two companies by mitigating and keeping them very much at average and pretty much okay for me to deal with in terms of my anxiety. So the next two on this list are a little bit more riskier. They're like going to the pool, having your life jacket on, and you jump in 2 feet in. While I am not sure that you know how to swim, however, having a life jacket leaves a little bit of protection for you in case you don't know how to swim. The first one of these three is MFA Financial, ticker symbol MFA. The reason why I like this company at the moment is because the book value is currently at $5.59. Its current share price as of June 25th, 2021 is about $4.76. So that means that I have a little bit more room in terms of me earning some money in terms of capital gains from this. So the reasons I don't like this stock is because the fact is that it stopped paying dividends during the pandemic, and also it needs to pay at least 90% of its net income as dividend, which is a bad thing but also a good thing, because if it pays dividend, that means that I'm getting as much dividend as possible from this company. But in addition to that, that means that the company doesn't have enough money on hand for them to actually fund their projects, as well as find different things that they can do to help the company grow. The fourth company on this list is Prospect Capital Corporation, ticker symbol PSEC, which I like to say PSEC. So PSEC is a business development corporation. The reasons why I like PSEC is that it pays a dividend. In addition to that, it has a book value about $8.18, but its current share price is about $8.82. That's a little different in terms of me purchasing this company more than its current book value. PSEC has been buying back its shares, so that means that the underlying fundamentals of what the leaders of this company think about it is that they find it valuable, so that's why I feel as though they're buying back shares. The P ratio of this company is about 4, which can tell me that that company is a little bit undervalued, and its dividend yield is about 8%. And the last company on this list is Atenex, ticker symbol ATNX. This one is like going to the pool and jumping in without any life jacket, and you are just going to hope for the best. Now, do you know how to swim? I don't know, but this one is a YOLO event. We don't know what's gonna happen, but nonetheless, this is a little bit more riskier than every single last one of the other 4 that I've listed. Our 10X is trying to do research and finding treatment for different cancers. Now, this company has been trading for about $13 on average for the past 5 years. But during the last few months, its price dropped to about $3 and some change. And I see that based on my research that I've done is that it's due to the fact is that they got a complete response letter from the FDA when they actually submitted one of their breast cancer treatment for review from the FDA. Now to me, that doesn't justify why their price need to drop by this amount. But to me, it feels as though that this is more like you're trying to complete an assignment, you take it to the person that needs to have the assignment graded, and they look over it and say, well, you know, this could be better, and I have some issues about these things here. So what I need from you is that you need to go back and fix these things. And if I find out that it actually is suitable because I have concerns about these things, then maybe I'll give you a grade to determine if this is worth the grade. That's something similar to what happened to them when they submitted this breast cancer treatment to the FDA. The complete response letter, they had some issue, therefore they told them they have to go back and work on it. And if and when this drug gets FDA approved, then the share price would likely go back to the prices that it was trading at the beginning of this year and even the 5-year average in terms of this company. But that's just my personal opinion. But like I said, this is a YOLO investment. The book value of this company is about $1.92. Their P ratio, they don't have any because they don't have any earnings, so they have negative earnings. They don't pay a dividend, so therefore, like I said, we are going in, we jumping in, and we don't have any life jacket. We're just gonna hope for the best and let's see if we survive this. So I know some of you guys are looking at this and like, why would you put your money in a company that has negative earnings? No, I've not lost my mind, guys. It's the fact is that they are doing research And with research, it takes a lot of time before you actually find something that works. So it's likely that everything that they are doing is costing them more money than what they are earning from their products. So if they actually get this right, that negative earnings for that period of time that they can have most likely will skyrocket to them making revenue in terms of the product that they are producing if and when they are FDA approved. But no guys, I have not lost my mind. So now let's go ahead in terms of the entrance strategy for these companies. VOOO, the current price is about $393.50. My best case scenario in terms of entrance price would have been at $350. But nonetheless, seeing that I'm going to start this thing, whatever the prices are, those prices are going to be my entrance strategies into these companies. But preferably, I would have liked it to be a little bit cheaper for me to do so. The exit strategy for VOO, there isn't any. What I'm planning on doing is keep putting money, at least $5 a month, into this company to see how it works over time, because the S&P 500, remember, is the top 500 companies in the US. Therefore, I want to see how putting in some money every single month is going to affect the overall return for this particular stock. The same thing goes for BND as well. It's an ETF, total bond market. Same thing, no exit. I would have preferred to pay it at $80 or so. But however, we're just gonna have to go ahead and do it based on the current price, which is about $85.60. Entrance strategy for MFA, the current price for it is $4.76. But like I said, we're just gonna go enter these companies at the prices that they are. Exit strategy for MFA, somewhere around $10. For losses, if it drops to $2, I am leaving. Entrance price for PSEC is going to be at $8.82. Exit for profit, around $12. Loss, if it hits $6.50, bye-bye, I'm out. For 10X, the entrance price is going to be $5.08. Exit strategy, about $10 to $12. For loss, I'm staying in it because it's going to be the minimum amount I'm going to put in this company so I can ride this out despite what happens with this company, even if it goes to bankruptcy. Yes, I've kind of lost it, guys. Now, for the moment that we have all been waiting on, let's dive into this portfolio distribution for this $100 for these 5 stocks. So started off VOO. I am gonna put in $30 out of this $100. And $30 at the current price that I'm buying in as of market close on June 25th, 2021 is gonna produce about 0.0762 shares. That's not a total share that you can buy. Come on guys, it's $393 for this company and I put in $30, so I cannot afford a full share. So this is a fractional share that I'm purchasing of this company, which is 0.0762 of a share. So VOOO pays a quarterly dividend. So every 3 months, you will be getting a paycheck for these shares that we just got out of this company. So the dividend payment of this company isn't fixed. It fluctuates throughout every single quarter. So therefore, based on the estimate of the last dividend payment, let's calculate how much we would earn in terms of dividend payment at these amount of shares that we have when the next dividend payment is. In addition to that, here is the calculation for the estimate that we would earn after holding this company for these amount of shares for an entire year. Next one, BND. I am also going to put in $30. Now at the current price at $85.56, this will produce about 0.3506 shares of this particular ETF. In addition to that, this company also pays a dividend, but it pays it monthly. So every single month, we will be getting a dividend payment for having these shares for purchasing $30 worth of this particular company. The dividend payment of this company fluctuates as well, so therefore it's not fixed. So here is the amount of dividends that you would have received based on a previous dividend payment for this company with the amount of shares that we purchased for $30. In addition, the estimate after 1 year of having this company, here is the total amount that we would have for this company if we continue with these exact same numbers for the dividend payment of this company. The third one, MFA. The current price is $4.76. I am gonna distribute $15 to this company, and $15 at the price of $4.76, we will get about 3.1513 shares. So we get more than 3 shares for this company. In addition to that, MFA pays a quarterly dividend. So every 3 months again, you will be getting a paycheck for each given share that you have. So MFA during the pandemic, as stated, is stopped paying its dividend. It recently started to reissue its dividend, but the last dividend payment for this company is going to be 10 cents. So at the current shares that we have, here is the approximate amount that we would get every quarter. In addition to that, here is the estimate that we would receive in terms of dividend payment if we keep these same amount of shares for an entire year based on this last dividend payment that was issued by this company. The fourth one, PSEC. We are going to distribute $18 into this company at the current price of $8.82. This will produce about 2.0408 shares. So we got more than 2 shares from this company at the current price that it has. Another beautiful thing about PSEC is that it pays a monthly dividend. So they pay a dividend of 6 cents. So at the given shares, here is the amount that we can expect to get every single month from this given company. And here is the estimate that we would get at the end of the year if we continue with these same amount of shares. And of course, we know ATNX is the last one. So we're gonna throw in the rest of our money into this company, seeing that it's the most riskiest one. I am gonna throw the remainder of the $100, which is $7, into this company at its current share price of $5.08. So buying $7 of this company at $5.08 give us about 1.378 shares. Remember, there's no dividend. We're only gonna be looking at capital gains, and once again, just remember this is $7 that I am content at losing into this company. And this entire $100 should be something that you are content with losing, seeing that you are investing it in the stock market. Once again, I don't know what your financial situation is. However, like I said, this is a portfolio I'm creating. If I was starting over, and based on what I've learned about myself, this is what I would do with this money and putting it into these companies. This is not a classroom, guys. I am not telling you what to do with your money. You can go ahead and do whatever you want with it. Like for me back when I was younger, I probably would have just go ahead and spend it on food, which is a necessity, or buy me something that I really wanted, which is a toy. For example, a game that I wanted to play on my PS3. So guys, don't let this guy in the red shirt tell you what to do with your money. You are in control of your earning, so do whatever it is you feel best with it. But in addition to that, we are going to be tracking this portfolio performance based on the spreadsheet that I've created for tracking it. And every single month, I'm gonna update you guys in terms of how the portfolio is doing, so that you can see how this $100 investment into this company would be behaving if I did exactly what I mentioned in terms of this particular video. I'm going to also be updating it, and if I continue to reinvest, or if I sell something, if I buy something else, if I find that the price drop, I'm also going to be doing that as well, like, as treating it as it was my initial portfolio that I'm doing. By the way, remember that I have all of these companies in my portfolio, so whatever I'm doing in my real portfolio is going to be reflected in terms of these companies as well. So guys, I hope this was a more practical example than the abstract ones that I've been sharing with you guys, and then you guys can actually go ahead and go on this journey with me as we track this $100 for the next few months, years, or whoever know how long this is gonna last. So with that said, thank you guys for stopping by. Hope you guys have found something valuable. If you appreciate and you enjoy this content, go ahead and leave a like, drop a comment down below, and let me know that you enjoy this content and you are willing to share it with your friends. Don't forget to like, subscribe, and share it. And see you guys again next time. And I know that most of us would have said that we could have just put it in the bank account, but maybe the next episode I will discuss why is it that I would or would not put this $100 in the bank based on my experience in terms of putting money in the bank. So peace, love, enjoyment. Deuces, I'm Audi. See you guys next week. Super.